two themes, pervasive themes over the past couple of years for Canadian financial markets have been momentum in private capital and the impact it's had on the number of listed stocks. We've seen an endless parade of privatization deals. It feels like one a week, bringing stocks off the TSX. We're joined by Neil Selfe, founding principal at INFOR Financial Group. Thanks very much for joining us.
Thanks for having me, Andrew. Good to see you.
And a pretty incredible statistic, in a decade, the number of stocks actually on the TSX down by about 35%.
Yeah, well, it's good to put Canada in the global context. In 2025, we actually saw a pretty decent rebound in global M&A. Deal volume globally was about 4.8 trillion, which was up about 30%. But when you look below that number, it's really quite nuanced. Deal counts were much more uneven, pretty well flat year over year. So the market's been defined by fewer deals, but larger, higher conviction deals, typically where there's strategic rationale and financing was available to execute those transactions. The dominant driver has been corporate transformation, as we saw with the big tech Anglo deal here in Canada. Canada itself, though, outside of the banks and some of the larger specialty companies, is really full of mid-market companies, and those mid-market companies have been picked off. I think many of them are undervalued, have been overlooked, and what we've seen is that, as you mentioned, a whole host of Canadian companies over the last 10 years, but particularly over the last year, going private. We, as a firm, INFOR Financial, advised on six go privates on the TSX, including Mubadala's acquisition of CI and Dental Corp's acquisition of GTCR this year. And we expect that pace to continue into 2026.
Yeah, so CI going private, that was the biggest deal you did, I think. And it seems a bit depressing almost that Canadian companies just can't attract valuations, can't attract investors in many cases.
Yeah, I think depressing is one word to describe it. Certainly, we are not, as a nation, replacing companies that are going private with new IPOs. It's not solely a Canada issue. Private capital has grown by leaps and bounds over the last few years and represents a real viable alternative to public markets today. And we're seeing private capital providers, both equity and debt, not only focusing on Canadian acquisition opportunities, but focusing on global acquisition opportunities. We expect that to continue. Sponsor-backed activity is likely to pick up as they are under increasing pressure to deploy that capital, which means that companies will function more in the private. We'll see more companies functioning in the private market as opposed to the public market probably going forward.
And Jamie Dimon of JP Morgan has expressed concern over the drop in U.S. listed companies. Apparently, he said in 2023, the number of U.S. public companies had dropped from 7,300 in 1996 to just 4,300 more recently. And he says, in some ways, this is a loss of transparency because these companies have to report under rigid rules how they're doing.
Yeah, I think it's a good point, but candidly, I think too much is made of the regulatory complexity of being a public company. Perhaps governments around the world will lighten up on that, and that would be welcome. But I think the real driver is we're seeing private equity funds and private debt providers just have much more resources to go after public companies. And if you're a public company, it can grow just as well with a private company, private equity backer. Why would you stay public? You've got greater regulatory burden, greater reporting burden. You've got a whole host of shareholders who have opinions on how you run your business. And so I think the driving force globally is the growth in private capital. But there's no doubt that Canada is feeling the impact of go private transactions probably as much as any exchange in the world. And that's a result in large part of not replacing our IPO candidates, either in the extraction industries, metals, or oil and gas. And even with AI, while we have a few national champions in AI, we just don't have as many up-and-coming tech and AI-related companies as you would find in the United States and perhaps elsewhere.
A couple, now I know these are not equity funds generally, but we have seen a couple of real estate and private bond funds halting redemptions in Canada.
Yes, I mean, certainly one of the issues that you have with funds that buy long-term assets, and it doesn't really matter where they're located, but have short-term redemptions is a mismatch. And certainly the Canadian real estate market has been very hard hit over the last couple of years, and real estate is extremely hard to sell in the Canadian market at what managers believe are fair prices. Mm-hmm. And so they have many Canadian real estate funds have halted redemptions to try to preserve long-term value.
Mm-hmm. We'd better jump. Thank you very much. It's a fascinating area. I really appreciate it. Neil Selfe, founding principal at INFOR Financial Group.